Hello, everyone, and welcome to today's Moomoo presentation. I'm Michael McCarthy, the CEO of Moomoo Australia, and with me today is Jessica Amir, our market strategist. And today we'll be looking at tariffs and the tariff wars, market meltdowns, and US rates and the implications for markets and investments. Before we start, though, there's some important information for you to consider. And on your screen now, you can see that important information. First of all, Moomoo Australia is licensed by ASIC, and our Australian Financial Services license number is on the screen there. It's important to remember that investment carries risk. Risk and reward are directly related, and in seeking higher rewards, investors are taking risks, and anyone thinking of using the Moomoo platform or investing generally should be aware of those risks. And perhaps even more importantly, the right decision in markets reflects your personal situation. We all come to the market with different goals, different risk appetites, different amounts of capital, different timeframes. And all of these differences means that the right decision in any given market situation depends on your personal situation as much as it does on the market. Now, we haven't taken into account your personal situation, so the decision about whether any of the information we present today is useful to you is a decision entirely for you. And if, having read our financial services guide, particularly with regard to the risks involved in investment, you still have questions, please seek independent advice. So today, we're going to be looking at the market action. And if you've been paying attention, you no doubt are aware of what we'll be looking at today. And one of the key questions we'll be asking initially is this a meltdown or a melt up? And Jess will take us through some of the recent market action and give us her views on what's happening right now in the markets. I'll then move on to have a look at why we saw the initial downturn and the rally back, and what's driving it, and what sort of signs we could look for to suggest we might be moving back towards a more normal trading environment. We'll then go on to think about what might be happening in the future. Now, none of us, no matter how hard we work, how experienced we are, or how smart we are, knows the future, but we can get some idea about what markets might do and paint several scenarios that give investors choices about how they might respond to the current situation. And then most importantly, we'll get to your comments and questions. Now, some people have already sent their questions through, and we thank everyone who has done so. They'll earn Moomoo points for their contribution, but it's not too late. If you have a comment or a question, please feel free to type it into the comments section. You can see just on the right of your screen there. And we'll get to as many of those comments and questions as we can at the end of the presentation. So let's start by looking at the current market action, what's happening right now. And for that, I'm going to hand to Jess.
Thanks, Michael. So for those who have been following, we've seen market fear, which we track on Moomoo or globally by the VIX, the volatility index. So it's pricked up to one of its highest levels since COVID-19, in fact. And the moves that we've been seeing day to day in equities have been as wild as the COVID era as well. And the reason for that is because Trump's only been in office for 80 days, only 79 days actually, but he's put tariffs on most of the world. And the worry and the concern is that no one knows what to expect. A similar scenario to COVID-19. No one knows what's going to happen to global growth, and no one knows what's going to happen to company earnings. And of course, the stock market is just a reflection of companies. Thus, we've got the S&P 500 in the US, and indeed the NASDAQ 100, the biggest 100 tech stocks in the US. So they don't really have a basis to be valued on at the moment. That's why they're kind of searching for direction. So the fear gauge, the market fear gauge, is just basically telling us fear and concern is still high. It's fallen overnight, but it's still around COVID-19 levels. So what's happened to the NASDAQ 100, the pin-up index, I guess? We've seen the NASDAQ 100 carve out a similar pull down to the first Donald Trump-induced trade war. Cast your minds back to 2018, when Donald Trump first got into power. A short duration after, he slapped on tariffs on most of the world. A very similar scenario is playing out to what we're seeing unfold now. The difference is investors might be cheering because the NASDAQ 100 jumped 12% overnight. It's a relief rally, I guess, for some, considering the NASDAQ 100 has fallen well into a bear market. It's down 23% from that record all-time high that it hit back in February. The kiss of death, perhaps, after Valentine's Day, would you believe it or not? The market hit a record all-time high and then tumbled down 23% to where it was overnight and then rallied up 12%. So why is this and what's happening right now, why are markets in turmoil, is simply because of uncertainty. The only certainty in town is that uncertainty is still persisting. So tariffs have been put on most of the world and increased on China overnight. Tariffs to the tune of 125% on China. The day prior, China retaliated as well. So the bottom line is it is affecting the NASDAQ 100. And as we've been illustrating on Moomoo, and thank you to those of you who have been tuning into our commentary, the average NASDAQ 100 company has got most of their costs tied up in China, particularly if we think about the top 10 companies in the NASDAQ 100, thereabouts a large chunk of their costs are tied to China. So that's why the market has fallen into a bear market. It's still down about 13% from its record all-time high, but there are concerns going on. So what is happening is that we have to remember that Scott Bessent, the US Treasury Secretary, said tariff negotiations could take place until May or June. And that's why perhaps if you believe that there is more downside ahead, which is quite probable in the market, you could have an opportunity to maybe take some profits off the table on the back of last night's rally. Indeed, we're seeing some clients do that at Moomoo. The other scenario is what happens if history does repeat itself and the market falls 37%, like in Donald Trump's first trade war. That's just something that some sophisticated investors are thinking about. But just wanted to set the scene here that volatility is still elevated. If we go back and have a look at the prior slide, the volatility index this morning did fall from that COVID-19 peak. It's now down to a level of 33.6, as we can see on the screen. All in all, volatility or market fear fell by about 35%. And perhaps that's why we've seen markets jump up 12%. But volatility concern, it's still very much in the air because we don't really know what is going to happen. And of course, tomorrow, well, if you are tuning in from the US, it's actually on the US session on Friday. We'll hear about the health of the American banks, and that might be a gauge as to what we could expect. But I don't think that that is going to be ruling out volatility anytime soon. But that being said, I just want to throw back to you, Michael. Can you just give us your take on why markets are so tumultuous right now?
Thanks, Jess. Yeah. And of course, as we all know, the headlines are being dominated by tariffs, but the tariffs that were introduced are not the end of the story. And one of the reasons, of course, for that is they've been a movable feast. We've seen them change in the space of less than a week on a number of occasions, and there appears to be a very fluid and reactive environment in the White House when it comes to the imposition of tariffs. We've seen 3 changes since that initial introduction. And so I won't run through each of the current situation because of that very likely scenario that they will change again very soon. But the key to where we're standing right now and the reactions that we saw in equity markets in particular were quite spectacular. Now, we'd already seen a bit of a pullback from highs before the introduction of these tariffs. We knew it was coming. A lot of investors seemed to be pre-preparing, and the markets had drifted sideways to lower in the lead up, but the actual introduction and the sheer size of the tariffs really scared the markets. And it led to a lot of commentary around the idea that the post-World War II phase of US globalization had come to an end. And that has implications for the globe quite naturally. Now, whether or not it is the end of an era, it's very clear that last Thursday morning, our time, or Wednesday afternoon, US time, a lot of damage was done to the world order. And people have pointed out, a number of business leaders here in Australia have pointed out to our government, which is facing an election, that businesses thrive on trust and confidence. And in moving in such a capricious manner, Mr. President Trump has demonstrated that there is nothing reliable or any reason for us to have trust and confidence in what he does, because the tariffs that he introduced against Canada and Mexico were in direct contravention and contradiction of a trade agreement he'd signed himself. And so when Mr. Trump makes a trade deal, it's not worth the paper that it's written on. And for that reason, whatever happens with tariffs, even if every tariff were removed tonight, the damage has already been done because of that erosion of trust and confidence in the US, and its position as leader of the free world is really in doubt here. Now, one of Australia's greatest reforming treasurers and prime ministers, Paul Keating, has said that tariffs are the death rattle of a dying empire. And his very dramatic and colourful language made him an outstanding parliamentarian, but his commentary has always been pithy and to the point. And that's the issue, that the way that these tariffs were introduced, rather than the tariffs themselves, but the way they were introduced, the alliances that they cut across, the rhetoric that was used around them, have really eroded trust in the US as a global ally and partner. And for that reason, as I say, even if the tariffs are withdrawn immediately, there will still be a risk premium applied to US assets. Now, that's an important word, risk premium, because it appears what really got Mr. Trump to back down was not the equity market sell down, but the bond market sell off. Now, in the initial 24 hours after the announcement of the tariffs, we saw equity markets selling down, but we saw bond markets rallying as that money was taken from the share market and put into the safe haven of the bond markets. However, early this week, that reversed. And it appeared that bond traders were starting to get concerned about the damage being done to the US markets, and also were keeping an eye on the billions of dollars of bonds that were due for rollover this week. And with last night, the rollover of both 10 and 30-year bonds, more than $37 billion worth, was probably the key reason why Mr. Trump backed down when he did, because it was a threat to the bond market and the big sell-off in bonds that reflects the damage done and the concerns around tariffs. And if US bonds are no longer a safe haven, it starts to lead to some very uncomfortable questions. Is the US dollar still the reserve currency of the world? And these are not questions that any politician wants to face, let alone a populist like Mr. Trump. So what does appear, it was the bond market sell-off that got the change in tariffs. Now, the reason tariffs are feared and the concerns that they raised can be summarised in one word, and that word is stagflation. Now, stagflation is a situation where we've got low or even negative growth or no growth. We've got rising unemployment or higher unemployment, and we've also got inflation bubbling up. And this is a particularly diabolical situation in economic terms, because the way we normally fight inflation would spur further unemployment and lower growth further. And the way we normally fight low growth and high unemployment would spur inflation higher. So stagflation is the worst of all worlds. Now, it wasn't believed that stagflation was even possible until the world experienced it in the early 70s in response to the energy shocks that came out of the Middle East. And it was only in that situation of low growth caused by those high energy input prices and inflationary pressures because of those high energy prices that the world for the first time experienced stagflation. And we saw the damage that it does to economies as structures break down in the low growth scenario or are ripped apart by higher inflation. And so that's why the market reaction to these tariffs was so severe. The introduction of trade barriers not only drives prices higher for citizens in the US, feeding into an inflationary cycle, but it also slows activity around the world. Economic activity is gummed up by the erection of trade barriers. So that concern about stagflation was the reason, or the reasoning perhaps, that we saw such a severe reaction. And it's that fear that still lingers, because simply taking your foot off the brake does not necessarily make the vehicle, the economy, go forward again. And so given the shakes to confidence, we're certainly likely to see a lasting impact from these events, no matter what happens in the future. And of course, if there's any indication that there'll be reintroduced tariffs, we could once again see markets move into panic mode. So a lot to be concerned about here. One of the barometers that I've been using as we go through this is the Australian dollar versus the US dollar. Now, the Aussie, as it's called, is widely considered to be a good barometer of sentiment around global growth. And the reason for that is the high dependence of the Australian economy, and particularly Australian exports, on commodities. Now, at the moment, what that means is coal, iron ore, and natural gas. In the past, it's meant other commodities. But the reality is, when the industrial outlook for the world is positive, and people are buying up raw materials and commodity prices are rising, the Aussie dollar is likely to go with it too. So when growth prospects are good, the Aussie tends to rise. When global growth prospects are not so good or declining, we often see the Australian dollar move to lower levels. And this is one of the reasons, once again, why we had a different reaction to, as Jess pointed out, the 2018 tariff introductions and the most recent ones. It's because the world was positioned a lot differently to the way it was in 2018. When the NASDAQ sold off in 2018, it fell from around 8,000 points to below 6,000 points. This time, it's falling from above 20,000 points. And it's not just the positioning of the market. The reality is that the US debt at close to $30 trillion has never been higher. And the US Federal Reserve's balance sheet is also very bloated, and with inflation rising, its hands may be tied, and it may not be able to come to the rescue of declining economies and markets. So all of these factors mean we're in a very different position, and that's why I believe the Aussie is signalling crisis this time around and didn't in 2018. And this long-term chart is a weekly chart. Each one of those candles represents a week's trading in the Australian dollar versus the US dollar. And the line, the horizontal line across the bottom of the chart, is 60 US cents. And as you can see, the Aussie this century has only been below 60 cents four times. This is now the fourth time. And the previous times were COVID, the global financial crisis, and the tech wreck of 2000. So when markets and economies are in crisis, the Aussie tends to be at these lower levels. Now, the good news is the Australian dollar bounced as part of the big rally last night. It's now trading above 61 cents, and that might be an early indication that the worst of the danger has passed. But if over the coming days and weeks we do see the Aussie move below 60 cents again, it could be a sign that markets don't believe that we're out of the woods, and there could be further selling to come. So a good barometer, a handy rule of thumb for investors looking at the market, particularly those contemplating when is the right time to buy. The Australian dollar against the US dollar might give the signal that you're looking for. So something to think about there. The US dollar is also an indicator itself, and its reversal after strengthening initially at the introduction of tariffs, it started to weaken. I think that also added to the concerns that the White House had, about the impact of the trade measures. So, having had a look at what's happening and what's driving it, let's now turn to what might be ahead for global markets and for you as investors. Jess?
So I think that was a great gauge and a different way that investors can think about gauging what is going on. So it's just also worthwhile echoing what Michael said. The fact that we did have, I'm just going to flick back, the fact that we did have or do have the Aussie dollar at the levels that we last saw at COVID, and we also have the volatility, the fear gauge at similar levels to COVID. It's telling you, I think, that even though we did see rallies, rallies in the Aussie and the fear gauge come down, it does tell you we may not be out of the woods yet. We need to potentially see consistency over the next couple of days. But speaking about the next couple of days and going back to your question, Michael, what do we need to consider ahead? And what do we materially need to see before markets maybe move higher? I just wanted to touch on these 3 key points that we've been speaking to clients about. The first one is what is a major concern and what is potentially likely to maybe see the day-to-day gains be quickly taken off the table and investors bunkering for downside is, number one, company earnings and revenue outlooks could be slashed. So this is a huge concern. If we do see this, this means that equities could head to lower levels. Of course, the biggest companies in the world are due to start to report earnings from this week. We said on the US session on Friday, we'll start to get a gauge of the health in how the biggest banks in the world are faring in the wake of the tariffs coming into effect, and importantly and critically, what they're seeing ahead. So we will really get a sense check of if companies' spending plans are likely to be cut. If that happens, that'll probably be a huge rattle of the chains, whatever you want to call it, to maybe get Mr. Trump to maybe make some changes. And just echoing a different way to say why I believe that Trump actually put a pause on some tariffs overnight is that point 2 at the top, we've seen a company earnings spending plans already cut. So in the last now 20 hours, we've seen Microsoft, one of the biggest companies in the world, walk away from their $1 billion spending plan to build a new data center in the US. A $1 billion data center project in Ohio. Microsoft said that they walked away from that and they're abandoning their plans because of that. In the wake of the tariffs creating so much uncertainty, they don't have certainty as to where they can put their capital to work. That's not good for America. It's not good for stocks because for continued investment in the health of the stock market, we need to see investment as we were just suggesting. So the third point is what is a concern for markets. We've seen a lot of money come out of equities and we're seeing a record amount of money go into cash. So $7.4 trillion of cash in inverted commas is on the sidelines in money market funds. So I guess that is a concern, and we are basically saying by highlighting this that sophisticated investors are concerned and they're worried that more downside could be ahead. But it's not all doom and gloom. Of course, as Michael said, we need to watch a couple of things. One of those, watch the Aussie dollar. Number 2, as I've been saying, keep an eye on the volatility and fear gauge. The fact that it is around 33 suggests that we might not see steady as she goes buying to pull the market higher. But number 1 point is, what do we need for markets to stabilize? Well, heaven forbid, we need certainty on tariffs. We don't really know. It's tit for tat. One day they're higher, the next they're even higher in terms of US, China, that is. Second of all, we need to see company outlooks come out and be not as bad as feared. If we see that, then you might see a rally in stocks, but I'm not sure if that's going to be the place or the case yet. And then the third point, what we need for markets to materially move higher, I think is some of that $7.4 trillion in cash come off the sidelines and into markets. But I dare say until we have tariff certainty, markets won't be able to move higher. And of course, you need to see companies affirm that things are not as bad as feared, but I'm not really sure that is the case as yet. I do think as well, just need to circle back to those points at the top. Just do be really considered here, and maybe see that when you do have some gains, if that is in the interest of capital preservation, if that's a part of your portfolio methodology, maybe think about taking some profits off the table if that's what you want to do. That's just a consideration. But Michael, that being said, we did see the Reserve Bank of New Zealand and India cut their interest rates yesterday. I guess that means, I mean, what's next for the Fed? Will they potentially cut? That's kind of like the big elephant in the room, because that may drive up valuations. I don't think that the Fed's going to cut next month, but what do you think?
I think there's been a lot of reliance on that idea, Jess. A lot of people assume that a slowdown in the economy and a fall in the markets will see the Fed spring into action. But I would bring to mind the Fed's dual mandate, that is to stabilise prices and maintain employment as close to full as can be done. So the concerns that people have about particularly market valuations and the idea that the Fed might jump into action just because the equity markets are selling down, I think is misplaced. And what a lot of people are missing is the fact that the Fed has reiterated that if fighting inflation remains its key endeavour, and while that's the case, and while inflation remains above the target level of 2%, the ability of the Fed to heavily defend the economy, to support the economy at lower interest rates and increased money supply, is greatly reduced. Now, in the case of both India and New Zealand, their problems are on the other side of the coin. Their growth is low and their inflation is low with it, despite the global inflationary impulse. And so their central banks do have the room to cut and to support their economies. But I think it can be argued quite strongly that the Fed is not in a position to do so. And central bankers generally have been very clear in the past about the distinction they make between the outlook for the economy and therefore employment and the outlook for markets, and that there's often divergence between the two. Now, a lot of politicians locally and around the globe have pointed to the interest rate market pricing of the future of interest rates. And we do look to that interest rate curve to get an idea about what professional interest rate traders are thinking about the market. But I think it's important also to remember that last year, for almost all of the year, interest rate markets were pricing 2 to 4 reductions in interest rates from the Federal Reserve, and we got one. So expectations in the market are important, but they don't mean that they'll always be delivered. And while the market is still very keen on the idea that there'll be 3 to 4 interest rate cuts this year, it's quite possible we could have a similar scenario with inflation persisting, getting stuck at higher levels, tying the hands of the Fed. And when we get to the end of the year, the Fed may have delivered 1 or 2 cuts. Now, a lot of people are getting very fired up about the potential for the Fed to cut interest rates by 0.5% at their next meeting in May. I think that that's a very overblown consideration, because if they're responding to tariffs, let's remember tariffs not only slow down the economy, they drive prices up. And in a situation where the major fiscal policies have the potential to spark higher inflation, it seems very unlikely to me that the Fed would cut, let alone cut aggressively by taking interest rates down by 0.5%. So I'd be very wary of that. I know that the share market is counting on that at the moment. I suspect there might be a gradual dawning that that won't be the case, or we might even hear more from the Fed. Looking at the minutes of the last meeting, it's pretty clear that their hawkish team members are very focused on those inflation reads, and particularly the core inflation reads, which are moving down much more slowly than the headline rates. So under the scenario, I think even the minutes that we saw this morning all reflect the idea that the Fed is not as keen on interest rate cuts as the market is, and at some stage there's going to have to be a reckoning, and that reckoning might put further pressure on shares, at least in the short term. So something to watch out for. I'd also like to say that because we describe markets with numbers, we sometimes think of them as mathematical or scientific or even logical. And the reality is they are not. Prices are a product of crowd behavior. And while those they basically represent the opinions of what people think are going to happen in that market in the future, because if they're buying, they expect it to rise, and if they're selling, they expect it to fall. So these are sincere opinions. People are putting money behind their opinions, but the prices in a market are a matter of crowd behaviour, the mass opinion of the crowd, the price which they find equilibrium for all their opinions. So this means that prices are the product of an organic process. They are not scientific or logical. But what that does mean is we can look at the way a price is acting. We can look at its behaviour because it's a product of an organic process and make determinations from that behaviour. And when a market goes up by 12%, as the NASDAQ did last night, that sort of behaviour is telling us that conditions are still unstable, despite the fact that it was a positive move. A move upward of 12% has not been seen since 2008, and it tells us market conditions remain very unstable. So while it's certainly good news for those who are long US shares to see such a strong rally, that sort of movement is also telling us that it's not over yet. And I'd add to the conditions that Jess put forward for a steadier environment and potential for the market to move higher is that we need to see the price behaviour calm right down. We want to see more regular trading ranges, daily trading ranges, less erratic movement, lower volatility overall, and less 180-degree turns from day to day. When we get to those more calm, stable trading conditions, then we might be able to argue that the markets are displaying behaviour that suggests they've now found a base and could well be moving higher. So I'd look definitely to the earnings in particular from companies and the spending intentions of companies, but I'd also look to the price behaviour of individual stocks and the indexes as well to determine when this crisis might be flushing out of the market action.
Just echoing what you said about interest rates, for those watching this at home or online, perhaps in your lunch break, or wherever you are around the world, it's worthwhile to point out a Fed speaker, just on the back of what Michael said about the Fed minutes. A Fed speaker actually came out, Kashkari is his name, saying that there's a lesser chance of interest rates to be cut in the US. And that's precisely probably why we did see the futures come down, betting there's less of a chance of rates being cut in the US for the next couple of meetings. So bets or expressed via the futures markets are suggesting there's less chance of rate cuts ahead. And every time that we hear commentary like this, it's just another headline and perhaps another potential disruption that could cause equities to be pressured lower. That's just another consideration for you as well.
So thinking about the market going forward, Jess, and one of the key factors now will be the interplay between China and the US, because it's pretty clear from the change in the structure of the tariffs that we saw last night that this is largely about trade between the US and China. And the world's two largest economies together account for about a third of all global economic activity. So this remains a major concern for markets. If the two largest economies in the world are at loggerheads, trading trade sanctions and retaliations back and forth, it's not only bad news for their economies, it's bad news for global trade. It's not just a distraction, it's a slowing, it's a redirection of global trade. And if this is part of the a reshaping of the global trade environment as the end of the era of post-World War II globalisation hits, then what the world looks like from there is hard to say. Now, locally, we've already had the Foreign Minister and the Minister of State reject the idea that Australia will be teaming up with any particular nation, despite some overtures from major players. But there's no doubt that trade relations will change. And it's pretty clear from what we've seen already that Europe might be a major beneficiary of these provocative moves from the US, with a lot of the globe turning their attention to the third largest economy in the globe that is as yet less affected by any tariffs. So the future will depend very much on how China and the US engage. The impact on Australia of tariffs was always likely to be small. They're at the lowest rate, and only 5% of Australian exports actually go to the US. So the direct impact from tariffs on Australia was actually low, but it's the impact on global trade that really concerned local analysts and strategists. The reality is, if China, our biggest export market, and the US, our staunchest defence ally, going against each other, it's very likely to have a negative impact on the Australian market. So it's still a wait and see, particularly for Australia, given that the trade dispute has now been centred on China and how important China is to the Australian economy. Locally, though, we're not coming from as stretched an environment. And although our debt and deficits are on the rise and of some concern, they were nowhere near the levels that we're seeing in other developed nations. So overall, Australia is likely to ride this one out in reasonably good shape, but that disruption to the US and China and their economies means that we could take some real short-term pain, and that might be reflected in our local share market as well. So that's what we're looking for. Anything else that investors should be thinking about as they look forward, Jess?
Well, before we get to the Q&A, and thank you to those of you who've sent your questions through, I just want to touch on a couple points and how inflation has actually or could be impacting Aussies here. So Bank of America this morning said, just in the wake of the tariffs on China, the average price of an iPhone could go up by some 90%. So please don't think that just because the tariffs are tit for tat between the US and China that it won't affect Aussies. It probably will. So that's a consideration. So that's why we're just encouraging you to think about, insert the word stagflation. It essentially means materially our prices for day-to-day items that we're paying may remain elevated, while economic growth naturally, because of higher prices vis-a-vis tariffs, higher inflation means that global growth is slowing. So that's why we need to think about that scenario. And rounding that all off and closing off this stagflation piece, to Michael's point, what are the benefactors of stagflation? So Michael mentioned Europe. So coming in this morning, it's interesting to see that the European stock markets are by far outperforming global markets. That's number one. So when we are speaking about what can do well in stagflation, we often look at foreign assets. So foreign assets might serve investors well when they are looking at diversifying out their portfolio, perhaps. Second of all, how else do you protect your portfolio from stagflation? Well, you could look at gold. So Michael spoke about the US debt levels exploding, tariffs also causing greater concern, inflation is going up, and vis-a-vis gold is a benefactor of that. And gold saw one of its biggest gains overnight in 5 years. But there are plenty of other benefactors. Is there anything else that you want to touch on before we get to Q&A?
I think we should get to the Q&A, Jess. And we've put the questions together in sort of similar categories. So we'll be looking at questions that are speaking to the same issues as a whole. And here's the first group on the screen there. And perhaps, Jess, you'd like to have a crack at, should we assume we'll see another drop in 90 days when tariffs resume?
Oh, that's a good question, isn't it?
It is.
Yeah. Well, I think negotiations are ongoing. And I think if we can listen to what Besant said, the US Treasurer or Treasury Secretary, he said that negotiations would take place until June. So I think volatility is the only certainty in town. As for if we see another drop, well, we don't know. No one knows. So if you are interested in preserving your profits, that's something for you to consider. Every investor is different. Every trader is different. They've got a different time frame for investing for the long term or trading, whatever their duration is. So potentially one would think that some are positioning for downside, but we could potentially see some rallies. We just don't know. As Michael said, and I agree, markets are very headline driven. And again, with elevated volatility, volatility being as high as it was in COVID-19, you'd expect markets to be very bumpy, at least for the next 90 days until we see company earnings come through, maybe not as ugly as feared, and tariff certainty. So we don't know. Do you want to take the next one, Michael, how fast will markets recover?
Well, that's an excellent question. If I could answer that one, I probably wouldn't be standing here, let's face it, because there's no way of saying that with any certainty. And anybody who is making certainty statements about the future at the moment is either fooling themselves or attempting to fool you, because there is no certainty available at the moment. All we can do is canvass the scenarios and position ourselves as best we can to try and take advantage of what we think are the most likely events to unfold. So how fast will the markets recover? Well, I'll let the markets tell me. I'll be able to tell by, as I mentioned before, calmer trading ranges, more stable prices, less reversals, and an overall calming of the price action in key stocks and in the indexes as well. So how fast will they recover? I would say this: I'm not expecting a COVID-style V-shaped recovery. And the reason for that is, as we alluded to earlier, that whether or not tariffs remain in place, damage has been done to the standing of the US with the rest of the globe. And that damage requires a risk premium on bonds, on shares, and on all US investments to reflect the fact that the US could change the rules at any time. And that premium will likely have a long-lasting effect. So we could have a fast recovery to a lower level. We could have a much slower recovery. We could see further downside. Significant downside. As I say, when a market rallies 12% in a single session, it's still a sign of instability in the market, which I think goes to another one of the questions on the sheet here. Is the sudden stock rally a false alarm? Well, it's alarming, but yes, I do think it's a false alarm. I would be very wary about jumping at the conclusion that it's all over and everything's A-OK, as I think some investors may have done with their buying overnight. And if nothing else, just from a simple market action point of view, I would be expecting a bit of a reversal of those gains in trading tonight. So if they do go on with it, that would be a very positive sign and something that I'd definitely be taking notice of. But questions like, is this a false alarm? The answer, I think we can definitely say, is yes. But how fast the markets will recover will depend on so many variables and so many decisions that have not yet been made that there's no way anybody could say with certainty. I just think it will not be a COVID V-shaped recovery style, even though last night's action is pointing to that at this stage.
Also encourage you to think about the prior session. Please remember the market was, everyone got excited because the market was up some 4% plus, and then the market ended down 1.6%. So please remember that in these uncertain times, markets are very volatile. And if you don't want to ride the bumps, as Scott Bessent said, expecting negotiations to take place at least for the next couple of months, well, then you should think about readjusting your time frame for investing. Do you want to take a long-term view? Whatever the case may be, think about your own strategy. A different way to answer that question, if I may, how fast will markets recover? Well, I'm not going to answer that same as you, Michael. But what I will say is history never repeats itself, it rhymes. Mark Twain said that. But if you have a look at the last trade war, the NASDAQ 100 hit a new high after 3 months. But this time, as we said, it's very different. The tariffs are far greater, not only upon China, but also upon Taiwan and globally as well. So that's why we can never say, markets could recover in 3 months. We don't know. As we said, fear has not been this elevated from COVID-19. Maybe we should flick over to some investing questions now from you. Michael, are banks worth investing in? Will they withstand a recession?
Well, it depends which banks we're talking about very clearly. If we're talking about Australian banks, then there is very good reason to suspect that they will hold up better than many other companies around the globe and many other banks around the globe. Their balance sheets are in better shape. Their provisioning is very much in check, and there's no signs of any sort of debt distress in the Australian market at this stage. So they may well hold up, but in a broad market sell down, just about every stock goes with it. And while we did see some holdouts in the selling over the course of this week, notably supermarkets, for example, there is generally pressure on the market, and even in the last 2 days, even the supermarkets capitulated, while some other utilities and broader retail stocks did okay in the environment. But when I say okay, they made either modest gains or didn't fall as far as the rest of the market. The idea that when we're going through a major corrective wave in global markets spurred by the US, the leading stock market, that there will be stocks going up is I think that's a concerning outlook. Now, for those who are long-term investors who have a buy and hold strategy and are looking to hold through the noise, then this might be a good time to look away because things might get uglier before they get better. But not necessarily speaking to just the bank stocks, but those stocks that have steady earnings streams, reliable earnings streams. And one of the reasons for the focus on supermarkets is that people don't stop eating even during a recession. But the steadier domestically exposed businesses are likely to be the ones that are favoured in any recovery of the market. That defensive aspect to their earnings and the now more defensive share prices and multiples they're trading on are likely to make them worthwhile. So the banks at this stage are showing no signs of distress. The key issue, though, is their relative expensiveness. CBA at its peak was the most expensive bank in the world of the majors. And although they're very robust and strong, the fact that they have enjoyed such good support and were the leading section of the Australian market over 2024 might mean they're a little more vulnerable to corrective activity than they have been in the past.
Can I just add to that? So with US banks reporting on Friday, really interesting to see that trading volume globally has spiked. Trading volume has been at record levels, at its highest level since COVID-19. So if we can round it out and think about US banks, those trading firms, I suspect that if you are looking at those in the US that report this week, vis-a-vis JP Morgan, Goldman Sachs, etc., you'd expect them to potentially be maybe benefiting from higher trading volume, very similar to what happened in COVID-19. And also just closing, maybe or thinking about that in a different way. Remember in COVID-19, we saw the biggest influx of new time investors into the market than ever before in the US and Australia. And so that might be one way to think about if you are interested in a long-term view of a bank, thinking at a trading bank. The names that we just gave just are examples only. They saw higher profits on the outside of COVID and some record profits benefiting from trading volume. So that's something to consider as well. But yeah. So what should new investors watch out for during a downturn? That's a good question. I think what Michael said about quality is really important. So focusing on those companies that have got high repeatable cash flows. So supermarkets, also think about where we're keeping the lights on. I suspect that's why Constellation Energy in the US is starting to see some buying. Constellation Energy is one of the biggest suppliers of nuclear power to some of the biggest tech stocks in the US. I suspect that's why investors think that company could maybe benefit over the long term. Some people may be taking a long-term view, but down under here in Australia, AGL, for example, Origin Energy, they've been seeing some buying. And back to Michael's point, in a recession, we still need to eat, we still need to keep the lights on. So that's stocks that typically tend to weather the storm better than most.
Mm-hmm. And I note here we've got, is it time to buy real estate investment trusts? An excellent question. And they're often thought of as safer investments because underlying these trusts are bricks and mortar assets. But it's very much a case-by-case business when it comes to the REITs, as they're sometimes called, because some of them employ leverage. Most of them employ some form of leverage. So understanding what sort of leverage is enacted inside the trust can be very important to understanding the overall risk profile of a trust. And a highly leveraged trust, although it might have good property assets, could still be a higher risk investment, especially in a scenario where inflation is keeping interest rates higher. So it might well be time to look at real estate trusts where their assets are in good shape, where their leverage is low, and where the cash flows are strong. That's the sort of investment that's likely to do well in a tougher environment. But when it comes to real estate investment trusts, they're not all the same, and investors must understand the individual risk profile of each trust before moving into it. That's the positive side, potentially, of a rougher investment environment. On the flip side, what sectors are most vulnerable or resilient in a long-term global trade war? Well, we've spoken to resilience. On the vulnerable side, I'd like to point to two areas. The first is tech stocks. Now, the reason for that, those high growth, glamorous, market darling stocks had trading on very high multiples. And it's interesting to note, even after Tesla halved in share price, it was still trading on 130 times earnings. And that sort of valuation remains very stretched. And it's not just Tesla. This is repeated across the sector. And wherever there are growth prospects that are hard to quantify, there are often multiples that are also very hard to justify in the sector. And so those high growth, high PE multiple stocks, I think, are particularly vulnerable. And throw into that fact the chip supply chains that run through Taiwan and other parts of China could very well be disrupted, even if only the US and China are at loggerheads. So I think tech stocks are particularly vulnerable. The other area that is really vulnerable, and we saw this realised in the market before last night's session, are the global growth exposed stocks. So these are the resource stocks, the miners, the energy stocks, that could be very exposed. Now, Constellation, I think, is a bit of an exception because of its US-based business. It's likely to stay within the walls of the tariffs, if I can put it that way. But the big miners and the big suppliers to the global industrial cycle, whether it's aluminium or iron ore or copper or gas or oil, they are particularly vulnerable to downturn in this scenario because the slowing of growth means that the outlook for commodities is likely to deteriorate very quickly if the trade war drags on. So I'd point to those high growth tech stocks and the globally exposed resource stocks, two areas of particular vulnerability. Any you're particularly watching, Jess?
I agree. Just echoing what Michael said, I think there's a good reason why in the first Trump-induced trade war of 2018, we saw the pin-up tech stock chip darling, Nvidia, fall 57%. Now, I guess there is a concern that its costs are going to rise significantly because most of their costs are tied to Taiwan. Taiwan's been hit quite hard with a lot of tariffs. And so too, they make a lot of their money from China. So two double whammies there for Nvidia. It could spell more downside ahead before a probable rebound. That's a consideration. Also, don't forget, I agree with Michael with Tesla. Tesla is facing more downside, I believe, simply because of the makeup of where they buy their core assets from to make their semiconductors themselves. They're also housing everything, building it in the US. It doesn't matter. They're still buying all their chips and all their hardware from Taiwan as well as China. As for what companies withstand tariffs the best, another way to answer this might be to think about subscription model businesses. If you are looking for companies to maybe buy the dip for the long term, think about those companies that may not be axed when a business is thinking about cutting costs. So think about subscription businesses like cybersecurity business CrowdStrike. I'm not sure of a company in the US that is necessarily going to cut their cybersecurity because of tariffs. I don't know what company wants to be hit by cybersecurity attacks. So that would be an example of a company to look at if you are thinking quality in tech. You want to still stay in the tech space. Another company to think about that could maybe not fare as bad as other tech companies, still staying in the vein of tech, is Netflix. So I'm not sure. Just ask yourself, would you axe your Netflix subscription if there were tariffs? Probably, maybe not. Not sure. So, but that's one way to skin a cat if you are thinking about companies that could potentially rally hard when we do see the upside bounce back. Don't know.
All right. Well, we're running low on time, Jess. We might rattle on.
So how will
these up on the
tariffs
screen?
affect the US dollar? Do you want to answer that one, Michael?
Well, and look, I think this is one of the fascinating part of the events of the last week. Initially, when there was talk about tariffs being introduced, there was a clear reaction in markets, and this is well before the April 2 announcements. But there was a clear reaction, and the first blush reaction from global investors was to move into the US. In other words, to get behind the trade barriers and get exposure to one of the largest markets or one of the richest markets in the world. So there was a lot of, there's quite a scramble for US assets, whether they were listed assets or bonds or physical assets. And that strengthened the dollar. That saw the dollar move higher. And I suspect there's also some repatriation of US investor funds to the US in preparation. And so the US dollar strengthened. And that was the view, that this strong position from the US would see them benefit and the rest of the world lose out. And a lot of people went for the dollar. But what really confounded things was, as the bond market started to sell off, so did the dollar. And it seemed to be a pretty clear sign that global investors had changed their minds and were moving out of the US altogether. And it appeared that there'd been a shift in thinking, whereas some thought the tariffs might be more milder than the ones that were introduced, or perhaps short-lived, or perhaps more focused. The blanket introduction really sent some panic around the globe, and people started to think about structural changes to the investment world and how that might impact their investments. And so that weakening of the US dollar, I think, was another thing that put pressure on Mr. Trump to back away from the severe nature of the initial tariffs. So what would we expect now is very hard to call, because it'll depend. If we are looking at a situation where the markets decide that this is a negotiating tactic and not likely to be long-lived, there'll still be damage done and a risk premium applied to US assets, but it's likely the dollar would stabilise and might even start to drift higher again. But if there's a perception that the global damage is ongoing and that the standing of the US has been permanently damaged, we might see the US dollar weaken substantially, because if the US no longer has the global leadership, then it's harder to make a case for the US dollar to be the reserve currency of the world. And if it stops acting as a reserve currency, there's a lot of holdings that could be shaken loose. And that's without even touching on the $30 trillion in bond debt that the US government has, and the fact that the two largest holders are Japan and China, two of the key nations that have been targeted by these tariffs. So perhaps some of the bond market ructions have been associated with selling out of Japan and China, although that has been denied at this stage. But if that were the case and we saw bond markets implode and yields take off, the US dollar would likely be slammed as those funds are withdrawn from US dollars altogether. So I think on balance, the downside risk for the US dollar is a lot more substantial than the upside risk, and it's likely to be much sharper if it's to occur. So that's the risk that I'd be looking at most in thinking about investments.
Maybe one more question. Global supply chains, how's the trade war reshaping that? Well, I think the oil price is a barometer for that. It's telling us a lot less global supply is happening, and that's why the oil price is down some 20% just in a matter of 5 days. So we did see a rally in the oil price overnight, but by the by, it's still down 20%. But 20 seconds on that, Michael.
Look, it's not just oil, but yeah, energy markets are very important to the globe. The reactions we saw there are important. We've touched on the chip supply chains, but perhaps the biggest impact will be in those large physical goods like cars, and particularly in the US, where a car chassis will cross the border with either Mexico or Canada or both multiple times during its manufacture. Could see a big change. And now we know that BYD has now become the world's largest seller of electronic vehicles, and developments like this and then the impediments to those supply chains, particularly in North America, could see Chinese manufacturers reassert dominance and in fact take up a lot of the ground that's been vacated by the US in this trade war. So it's very likely we will see a reshaping. We mentioned earlier too, a lot of nations and groups turning towards Europe. I expect that to be ongoing as well. And I think the overall impact will mean that we'll see a greater diversification by every nation to reduce their overall risks of exposure in their trade efforts. Right. Well, I think that will bring us to the end. Thank you very much for joining us today. We will be posting a recording of today's session if there's anything you'd like to go back and have a look at, and we'll try and answer any questions that we weren't able to get to during today's presentation. But keep your eyes on the Moomoo community for our next Moomoo webinar. Thanks, Jess.
Thank you.